Hi and welcome back to our second part of our video where we discuss in depth the 20K position strategy. Just to recap, and the first video is going to be obviously linked in the description below. The concept is we take a position which is fixed, we decided, and there is a full explanation why it's $20,000 per position. It doesn't matter if the price of the share is $10, in that case we buy 2,000 shares, or it is $200, in that case we buy 100 shares. The position stays at $20,000 and we risk 1% per position to the max. So the stop loss in the platform is 1%. So what's the worst thing that can happen? We lose 1%. There may be some slippage, 1.1%. That's very clear. What's the benefit of the strategy? That you know and accept from the beginning, and you don't have any surprises in terms of your loss. Now when people ask me, okay, what about slippage, overnight? Overnight is not relevant. Why? Because we don't hold positions overnight. If you hold positions overnight, 1% stop loss is a joke. It can't happen. Okay, so that's out of the ballpark already. Now what about slippage? We're trading stocks that are above 5 million per day or more. You can get more liquidity than what we ask from. Okay, that's why we are basically focusing on a very, very narrow range list. We call it the daily power list. Okay, so sometimes we expand to other lists as well, because again the demands are very harsh, but 5 million shares, that's a lot of liquidity. So there is always a chance for slippage. That's why I add another 10%, so you don't lose 200, you lose $220. Big deal. But that's again on the worst case scenario. It's not like you're going to sit, the stock is moving $3 in the money, you're not doing anything, and then it drops $5. It can happen, but you have obviously a management tool that will prevent you from turning a winning trade into a losing trade. That's definitely not going to happen. Now let's move on and decide and talk about the management. Okay, so what happens? Let's look at this example in front of you guys. So this is today, July 1st, and we're looking at this breakdown here in a symbol NBIS. The stock breaks, again, round numbers. That's our philosophy. Trade as much as possible around round numbers with a trend. In this case we have a bear flag formation. The risk is exactly 53 cents. You can measure it on your platform, and therefore it fits the strategy. But again, when I say the risk is 53 cents, that's it. That is the risk if the stock breaks 53 and starts climbing and it hits our stop loss at 53.30. So that's a scenario that's on the table. It can happen that the stock breaks down 40 cents and then moves back up to the entry and then up another 50 cents. Also a scenario that can happen. Now, if the worst case scenario happens, we already accepted it from the beginning, because we decided that our worst case scenario is 50 cents of risk. In this case, we're going to lose on this stock 1%. 1%, and this is $400. I think this is $400 in this case. $53 per share, 400 shares. Yeah, $200, my mistake. So 1% is $200. Okay, so now we
want to stop guessing and start trading like a pro? Join our one-on-one mentorship program. Learn high-impact, low-risk chart patterns, risk management, and experience with live execution. Get expert coaching and one-on-one training and support. Get your day trading green with strategies that work. Sign up today. Spots are limited. Email thechartsmaverick@gmail.com.
see that the stock starts to move lower, so that's a good trade upfront. But how do you manage it? What happens when the stock is now down to 50? Okay, are you still in a position? Are you selling? Are you adding? What the hell is going on? Now, being that if I'll ask, and I think I said it before, if I'll ask 10 traders, how do you manage? We're going to get 10 different scenarios. Some will add, some will take profits after 50 cents, some will take profits after 25 cents, some will take profits after $3. Again, this is something that it's your own decision, obviously. But we want to teach a strategy, and the strategy says, and it's based basically on facts. Okay, you're trading 13 stocks out of 1,000. So in the list, daily power list, NBIS is in the list. There are only 13 stocks on the list, which makes NBIS today, July 1st, very, very special. Let the trade run and don't do anything. Don't manage. Let the market manage it for you. Now, what's behind this concept is that we don't know anything. We don't know if the stock is going to break 53 and drop 5 cents and then move up $1 because the market changed. Trump said something. Maybe something happened in the stock. Maybe something happened in the sector. So many variables around the move here. Okay, so the worst case scenario is given. Now, the good scenario is, what is a good scenario? If you take $1 out of $5 move, is this a good scenario? If you take 20 cents out of a 21 cent move, is this a good scenario? So we're not looking for a 21 cent move. We're looking for the big move. That's why we're trading 13 stocks out of, let's say, 6,000. You do the math, what is the probability of a stock to make it into this list. So the probability is very, very low. Not zero, but very, very low. So now the question is, what do you do? I mean, the stock is at the lows of the day at 53, basically at 11:30. You can see it actually here. Hold on a second. That's the lows of the day, those two red lines, and then it climbs up $1.50, moves down, moves up. It's under the VWAP, and now that's already very late in the day, and the stock is basically now, yeah, that's after 3 p.m. So now the stock is basically at the lows. What do you do? Okay, there are so many answer to this question. Obviously, should you stay there with the stop loss at the entry? Maybe you should elevate the stop loss. Now, again, I'm not going to dwell into that because it opens up so many scenarios. The idea here is that you sell the position at the close, and if the close is going to be now it's at 50, it's going to be 48, you made another $2, which is a beautiful move late in the day. And if it goes back higher, you lose $2 if it moves up $2. So you need to trust the system, and the system says you're trading one of the worst stocks in the market today. NBIS is down 10%. It should close at the lows of the day. If it doesn't close at the lows of the day, too bad, but you still most likely will make money on this trade. Now, can it happen that the stock drops another $2 in the last hour? Of course. Can it move up $2? Of course. Anything can happen. Therefore, you don't know anything, but being that you're trading a terrible stock today, you should trust the strategy. And the strategy says sell it at the close, or in this case cover it at the close, and you have to wait another 45 minutes now. So that allows this strategy to avoid mismanagement, adding to positions, turning a winner into a loser, all kind of pitfalls that you go along, and you add too much, and then the trade goes against you. And as you can see, there are adding points here that I just point out, one at 51.28, and there's very little risk. But the idea here is to be as simple as and basically let the emotions run out. Okay, so don't do anything. Don't bring more emotions into the trade. We are so greedy anyway. Now we want more greediness. The stock is doing very well. It's up it's down $3 on the trade. How much do you want? I mean, you want another $5? Of course I want another $20, but you have to realize that we're doing something that is manageable and logical. Now again, we want to deal with the psychology of the trade, and the psychology of the trade is what plays a crucial role, sometimes even more substantially more important than entering the trade. And being that I've been in this boat myself, where I killed, I don't want to say millions of dollars, but killed a lot of trades with mismanagement, perfect entry points, horrible mismanagement. This strategy takes away a lot from these pitfalls, which are trade management. Trade management is something that can go very wrong, and the market is ruling here. Let the market rule. So I hope you accept this logic behind the strategy where you enter a trade. I didn't talk about the stop loss management. We'll do it in our next video, I hope, if we'll have time. So again, as always, we're running late with these videos, which are limited to 15 minutes. Okay, so the trade management and psychology are being taken care of. Now, anybody here will tell me that you have real life stories, and it's so tough to manage a trade, and I think this strategy takes care of this super important point of view. So let's summarize what we've done so far. We put it all together now in 5 points. We decide already at the risk per trade, 1%. We know exactly that this 1%, maximum 1%, is a technical level. It's not a random 1%. It can be a random 1%, but that's why we're day traders, we're professionals, don't want to be a random number. We want to look at the chart, see if the chart is telling us that the risk is 0.5%, 1%. If it is 3%, it's your money. You can still take the trade, okay? But it doesn't fit the strategy. The strategy tells us 1% based on the chart, okay? So that's the stop loss. Now, position size, we don't have to do anything other than compute. $20,000, $200 position, 100 shares. $2,000, $20 position, 1,000 shares, and so forth. If you trade out of the US, you don't pay commissions anyway. Now, trade management taken care of. We close the trade at the end of the trading day. One more thing that I didn't keep, and you guys keep asking me, what about the stop loss? Okay, does it stay at a 1% or we move it down to the entry? And the idea here is, once you are 1% in the money, move the stop loss under the entry or above the entry if it's a short trade, couple of cents above. Does it guarantee something? No, it doesn't guarantee anything. It can happen that it's logical, but the stock can move back up to the entry, take you out, and then drop whatever on a short play, or go long on a long play. So there are no guarantees either way, but it gives you it gives us the peace of mind that the trade is not losing money. Therefore, you are not in a position to be anxious because the trade is safe. And I think this is a super important point, and let's leave it at that. Okay, guys, hope it was again illuminating. I know that this is a hot topic. We'll see you guys in the third video.